What if I told you that your everyday habits might be silently draining your savings? In 2026, many of the financial pitfalls we fall into aren't obvious. They don't involve extravagant purchases or careless spending. Instead, modern habits, made even more invisible by technology, are eroding your wealth slowly and surely. You might be unaware, but these habits are sinking your savings account before you even notice. Stick around as I reveal the top 8 financial habits that could be destroying your savings in 2026, and learn how to break free from them so you can start building wealth instead of losing it. 1. Algorithmic auto-upselling acceptance. In 2026, AI-powered shopping platforms are getting smarter than ever. These systems are designed to suggest perfectly paired add-ons that you never even considered purchasing. It starts small. Maybe it's an extra phone case or an accessory for your new gadget. The problem? You end up clicking Add to Order without a second thought. Those tiny under -10 add-ons don't seem like much, but they're quickly adding up to a significant drain on your savings. This phenomenon, known as microbleeding, can quietly eat away 5 to 10% of your monthly income. Since these purchases are so low in price, they don't register as important, and you might not even notice them in your bank statements. However, when these small charges accumulate over time, they can easily drain your budget. You may find yourself spending hundreds on things you never planned to buy in the first place. The fix here is simple. Start thinking critically about those recommended items. Before clicking Add to Order, take a moment to ask yourself if you truly need them. If not, skip them. It's a small step, but consistently resisting these automated upsells will save you hundreds over time and help you keep your budget intact. 2. Chasing yield mirage and DeFi. The world of decentralized finance, DeFi, promises high yields, often offering returns as high as 15%, which sounds like a dream come true for anyone looking to grow their savings. However, this dream can quickly turn into a nightmare if you don't understand the hidden costs associated with DeFi investments. When you move your savings into high-yield liquidity pools or speculative stablecoins, you're ignoring transaction fees and tax complexities that can eat up your profits. You may think you're getting a great return, but by the time you move your money back to fiat to pay a bill, the gas fees and short-term capital gains taxes might have eaten your entire profit. These hidden costs can make your high returns look much smaller than you expected, and often they can turn into a net loss. The key to avoiding this is simple. Be cautious when chasing yield. Instead of jumping into high-risk, high-reward DeFi pools, take a step back and consider more stable investment options that offer predictable returns. While the promise of big yields is tempting, it's important to look at the full picture, including fees and taxes, before committing any of your hard-earned savings to these investments. 3. The freemium feature creep. In 2026, almost every app or software uses the freemium model. You get access to a basic version for free, but in order to unlock extra features, like an ad-free experience or power features that boost productivity, you're encouraged to upgrade to the premium version. It's easy to fall into this trap, especially when the cost of the upgrade seems minor compared to the benefits. However, this habit can lead to feature creep, a scenario where you're continuously upgrading to the pro versions of every app you use, creating a fragmented subscription overhead. What might have started as 1 or 2 premium apps now becomes a long list of monthly charges. Before you know it, you're paying for features you don't need or even use, draining your savings in the process. The fix for this? Audit your subscriptions regularly. Evaluate whether you're really using the premium features you've paid for. If you're not, downgrade or cancel them altogether. It's easy to overlook these ongoing charges, but by being vigilant and selective about your app upgrades, you'll save money and keep your budget on track. 4. Using phantom credit for essentials. By now, pay later BNPL services make it easy to buy everyday essentials on credit, but they can trap you in debt. As you pay off last month's purchases with next month's income, it becomes hard to save. BNPL encourages overspending, with interest and fees piling up. To break the cycle, shift your mindset. Instead of relying on BNPL, focus on building an emergency fund and saving for purchases. By prioritizing savings in your budget, you'll stop using credit for essentials and start using your income more wisely for long-term financial health. 5. Neglecting digital hygiene and security. In 2026, the digital world is increasingly vulnerable to cyber attacks, and if you're not careful with your financial accounts, you could be putting your savings at risk. A simple password isn't enough anymore. especially when AI-driven phishing attacks are capable of bypassing traditional security measures. These security lapses make it easy for hackers to steal your information and drain your savings. Cybersecurity is more important than ever, and neglecting it can lead to a loss of money that took years to accumulate. The solution is to make your digital life more secure. Use hardware-based security keys, enable multi-factor authentication, and regularly update your passwords. A small investment in digital security can protect your savings and prevent a potentially catastrophic financial loss. 6. The side hustle reinvestment trap. The gig economy in 2026 is thriving, and many people are pouring their side income into tools or courses to improve their businesses. While it's great to reinvest in your business, it's essential to balance that reinvestment with personal savings. Too many entrepreneurs fall into the trap of using 100% of their side earnings to fund their business ventures, leaving nothing behind for personal financial growth. By neglecting to take a portion of your side income as a founder's dividend for your personal savings, you're working a second job just to fund a hobby or business. While business reinvestment is crucial, it's also vital to secure your financial future by saving part of your earnings. To fix this, commit to putting at least 10% of your side income into personal savings. Treat this as non-negotiable. This habit ensures that your hustle contributes to your financial stability, not just the growth of your business. 7. Over-reliance on set-and-forget automation. Automation is an amazing tool for managing finances, especially when it comes to investing or saving. However, an over-reliance on automated systems without manual oversight can lead to poor financial decisions. If you set up automatic contributions to your investment portfolio or savings account and never review them, you may be missing crucial changes in market conditions or fee structures. In 2026, the market is volatile, and what worked last year may not be the best strategy this year. For example, an automated portfolio that was once low-cost might now be riddled with high-fee funds that eat away at your returns. Blindly trusting automation without checking it regularly can cost you more than you realize. The solution is simple. Take 10 minutes every month to manually review your automated systems. Check that your portfolios align with your current financial goals and ensure that the fees associated with them are still competitive. Regular reviews will help you stay on top of your investments and ensure that automation is working in your favor. 8. Ignoring energy efficiency surcharges. In 2026, energy costs are more complex than ever, especially with the rise of green energy pricing and variable utility rates. Running hydro appliances like electric vehicles, EVs, or smart home hubs during peak demand hours can result in utility bills that are 3x higher than average. If you aren't optimizing your energy use to off-peak hours, you're wasting money every month on energy that could be much cheaper. The solution is simple. Shift your energy-heavy tasks, like charging your EV or running your laundry, into off-peak hours. Many utility companies offer incentives for using energy during lower demand periods. By adjusting your habits, you can significantly lower your monthly utility bills and free up more money for savings. So, how many of these habits are you guilty of? In 2026, it's easy to fall into traps that slowly drain your savings without even realizing it. From AI-driven upselling and BNPL to ignoring energy efficiency, these modern habits are quietly eroding your wealth. But by staying vigilant and making small adjustments, you can take control of your finances and start building savings rather than losing them. If you found this video helpful, don't forget to like, share, and subscribe for more tips on managing your money wisely. Remember, it's all about making smarter choices, even in a world of invisible financial pitfalls. Thanks for watching, and I'll see you in the next video.